Welcome! Today, we're going to try and decode the incredibly complex world of Indian income tax. We are tackling a question that honestly trips up a lot of people who have any kind of international financial ties. So here's the fundamental puzzle, right? Maybe you're an Indian citizen working overseas, or maybe you're a foreign national doing business in India. The rules can feel like a total maze. But here's the thing, it all follows a pretty clear logic once you actually see the framework. So here's how we're going to break this down. First, we'll look at the core puzzle. Then, we'll define what Indian income even means. We'll get into a little twist called deemed income, see who pays tax on what, and finally, put it all together with a case study.
Okay, let's dive right in. Believe it or not, this whole complicated system really just boils down to two key factors. You get these two things right, and they tell you exactly what your tax liability is going to be.
It's all about answering two questions. Question 1. What's your residential status for tax purposes in that specific year? And question 2, is the money you made considered Indian income or foreign income? If you can answer those two questions, you've basically cracked the code.
All right, so let's dig into that second piece of the puzzle. What is Indian income anyway? See, the law has these two different tests, and this is important. An income only has to pass one of them to be taxable in India.
Okay, the first test is received in India, and honestly, this one's the easy one. It's all about where the money physically lands for the very first time. If someone hands you cash in India, or if a payment hits your Indian bank account, boom, it's considered received in India. It's as simple as that.
All right, now for the second test, accrued or arisen in India. This is where things get a little bit trickier. This isn't about where you get the cash. It's about where you earned the right to get paid in the first place. And the rule for this is different depending on whether you're selling goods or services. And this is such a critical difference, you really got to get this. For physical goods, the income accrues where the deal is sealed, where the sale happens. But for services, it's totally different. It's about where you physically perform the service. Okay, let's put this into a real-world example, something we can all picture. Let's say Salman Khan signs a contract in Mumbai for a big show in Dubai. Well, it's a service, right? So it doesn't matter that he signed the deal in India, he's performing in Dubai. That's where the income accrues. So right now, it's looking like foreign income. But, and here's the big but, what happens if those Dubai organizers wire his payments straight into his bank account in Mumbai? Well, even though the income accrued outside India, it was received inside India. It passed that first test we talked about. And just like that, it flips. It becomes Indian income and it's fully taxable in India. Okay, so just when you think you've got a handle on received and accrued, the law throws in a curveball. It's something called deemed income. Think of it like a legal assumption the tax code makes to stop certain incomes from slipping through the cracks. So why would they do this? Well, think about an Indian diplomat working at the embassy in Dubai. For tax purposes, they're probably a non-resident. They're performing their service in Dubai, and they're probably getting paid into a bank account in Dubai. So if you just follow the normal rules, India can't touch that money, even though it's the Indian taxpayer footing the bill. That doesn't seem right, does it? Well, that's exactly what the deemed rule is there to fix. So this legal assumption kicks in a few very specific cases. There's the government salary we just talked about, but it also applies to things like dividends from an Indian company's shares or interest paid by an Indian business. In all these situations, the law basically steps in and says, nope, doesn't matter where it was technically paid or earned, we are deeming this to be Indian income, end of story. All right, this is the moment where it all comes together. We've got our two pieces of the puzzle, your residential status and the type of income. Now, let's put them into a simple chart and see who actually pays tax on what. Okay, this table right here, this is the whole game. First, just look at that Indian income column. See how it's taxable all the way down? That's the easy part. The real difference is over in the foreign income column. If you're a resident and ordinarily resident, or an ROR, you're taxed on your worldwide income, period. If you're a non-resident, NNR, you pay zero tax on your foreign income. And then you have this middle category, the RNOR, who only pays tax on foreign business income if that business is controlled from India. Look, if there's just one thing you take away from all this, it should be this. If the money is classified as Indian income, everybody pays tax on it. All the confusion, all the planning, it's almost always about who is on the hook for their foreign income. Okay, theory is one thing, but let's see how this plays out in the real world. We're going to run through a quick case study to put this whole framework to the test.
let's talk about a German national. We'll call him X.
First things first, we got to figure out his residential status. So, step one, how many days was he in India last year? 153. Well, the primary condition is 182 days. So he's less than that. He fails that first big test.
Okay, but there's a second test, right? So let's check that one. He was in India for more than 60 days this year, so that part's met. But when we look at the 4 years before that, he was only there for 335 days. And that's not enough. He needed 365. So he fails that test too. So since he failed both of the main tests for residency, the verdict is in, he's a non-resident, an NR for tax purposes. And what do we know from our matrix about non-residents? They only have to pay tax on their Indian income.
Awesome. Now that we know he's an NR, we can just go down his list of earnings and sort them out. Business income in India? Yep, that's Indian, it's taxable. Interest from an Indian company? That's deemed income, also taxable. What about a dividend from a non-Indian company? Nope, that's foreign income, not taxable for him. Business in Germany, even if it's controlled from India, still foreign income, not taxable. House in Germany? Same deal, not taxable. So, at the end of the day, what's his total taxable income? We just add up the stuff that's on the hook in India. That's 40,000 rupees from his business, plus 2,000 from the interest. His total taxable income in India is 42,000 rupees. See? Once you have the framework, you just follow the steps and it leads you right to the answer. And there you have it. That's how you can cut through the confusion of India's tax rules for international income. It really just comes down to those two factors, where you live and where the money comes from. Which, of course, leaves us with a pretty interesting final thought. Now that you know how the system works, how could someone legally structure their travel and their payments to optimize their own tax situation? Definitely something